Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I'm Paul Winkler, talking about the world of money and investing. Educating investors one at a time, because the educated investor, harder to take advantage of you. And that's the idea here. Okay, so one of the topics that was very popular last year was just retirement plans in general, 401ks, and of course this time of year, it's what people are thinking about. New Year's resolution, maybe get the finances in order. So let's talk a little bit about just that. Now, you may have a 401k, 403b, 457 plan. It might be an IRA, but in general, there are concepts that are the same across them. So I'm going to talk in general about when you're going to a 401k meeting and they're saying, hey, we need to choose investments for your 401k. What do you want to put your money in? Now, a lot of people are going to go, I don't know. I don't do this for a living. What should I put my money in? And typically, what happens, a salesperson just says, 401k, whoever's handling it, says, well, just put your money, if you don't know what to do, just put your money in a target date fund. They're not going to choose the funds for you. They don't want that responsibility. Just put your money in a target date fund. You go, okay, great. What's that? Well, that's the one that has the numbers after it. So it's target retirement 2040, 2035, or if you're going to retire in the year 2050, just put your money in the target 2050 fund. And you go, okay, great. You just stick it all in there. Now, some people make the mistake and they choose, 8 different funds. I'll put a little in the 2025 fund. I'll put a little money in the 2050 fund. And, that's not what they're meant to be. This meant to be a one-stop shop. You just put your money in there. Or, you go and say, I'll put a little bit in this one. I'll put a little in the international fund. I'll put the target date fund, 2040 fund. I'll put a little bit in the small cap fund and blah, blah. And that's not what it's designed for either. But, that people will do that. Now, target funds are something I've talked about many times on this show and said, I'm not a big fan. And the reason, there's a lot of reasons. I mean, if you look at the way they're actually mixed, typically very, very heavy in certain areas of the market, very heavy in the areas of the market that most Americans are enamored with, which are large companies, U.S. companies in particular. Some fund companies do an indexing approach, and they write, hey, we're really, really cheap, and we use an indexing approach, and it's really super inexpensive, like Vanguard does this. And they'll have the target 2040 fund will be in the total U.S. Index fund and the total international market index fund and a total bond fund and so on and so forth. And what's the problem with that? Well, if you look at the academic research, where do we expect more return? Large or small companies? Well, of course, it would be small companies. 83% of 20-year periods, small companies do better than large companies. 83%. That's a pretty high number. And what are they doing? They're focusing more on big companies because they weight based on the size of the companies in an index fund, like a total market index fund. They weight based on the size of the company. So they're going to overweight the big companies. Well, I expect more return on small. That doesn't help. Well, it's cheap. So, you go broke and it doesn't cost much. Then you have, you just don't want to do that, but that's what they do. And then you've got, for example, value companies. 96% of 20-year periods, value companies do better than growth companies. 96%. That's a pretty high number. And what are they overweighting? Growth companies in these funds. So you go, good grief. What is it a popularity contest? Is this better for the investor? No, it's not better for the investor, but that doesn't cross the minds. And then you got, but it's not just, Vanguard's Fidelity. They do, Vanguard or Fidelity, they play both sides. They have active management, which is stock picking and market time. When you hear me say active management, I'm talking about a fund manager goes in and tries to pick which growth companies are going to do better than others, which small companies are going to do better than others, which market segments are going to do better than others. And active management, you'll hear that active management doesn't do as well as indexing. And it can be really confusing because you hear that and you go, well, then just indexing. Why did Paul say that indexing was a problem? Because when they do the research, they do it right regarding that. Actively managed small cap fund where you're picking stocks out of a universe of small companies does tend to underperform a passively managed fund. Now, the problem is there's a whole new level with small caps because you could have a fund that's passively managed that isn't overweighting the bigger small companies. You see how confusing this gets? And then now you've misled people by saying indexing is better. If you an actively managed, or if you're looking at active large company growth, like a fund that's investing in large growth companies versus the S&P 500, it's typically the active management doesn't do as well. But people don't hear the nuances, and it just gets confusing. So anyway, back to the issue at hand here. Okay, remember, small companies, higher expected return than large. Value, higher expected return than growth, and they're overweighting within target date funds. And it doesn't matter what fund company. If you look at American funds, same thing, they're overweighting big companies. Matter of fact, they don't even have they've got a fund that's called a small cap fund, but it's actually investing in mid cap stocks. So they don't even have one that invests in that area market. And then you got, T. Rowe Price, and you got all these different fund companies out there, name it, John Hancock, whatever. They have these target date funds, and they overweight the big companies, and they overweight the growth companies. Well, it's something I've talked about for a long time. Well, finally, there is an article in the Wall Street Journal that has come out that says why target date funds might be inappropriate for most investors. Thank you, Wall Street Journal. Target date funds are inappropriate for investors. It says if you're a typical investor, it might be okay. And I would disagree with that because of the reasons I just said. It might be okay if you're a typical investor. Well, what's a typical investor, A? And is a typical investor that somebody that likes overweighting big companies and overweighting growth companies and likes getting lower returns? I don't know. That's the only part of the article that I really disagree with. But I digress. I had to read it. It's a finding of new research, the National Bureau of Economic Research, circulating in December. Jonathan Parker, professor at Massachusetts Institute of Technology, candidate for MIT, blah, 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 and so on and so forth, did this research. Says, for investors 40 or so years from retirement, for example, typically around 90% of portfolio investments are allocated to equities in these target date funds. And they have these glide paths. They're going to start off with so much in stocks and then reduce the amount of stocks until you get to retirement. The equity allocation declines gradually, and 90% is okay. If you're young, 90% is typically fine for most people because you got a long time, not worried about market fluctuation. So, and that's where I'm in agreement with this. Yeah. So, and that's maybe what they meant by that. It's appropriate for some people because they do tend to start with, well, no, I'm not in agreement because still you have the problem of overweighting large companies and growth companies. Anyway. Equity allocation declines gradually to around 50% for investors at retirement age, and to as low as 30% for those well into your retirement years. And say, well, there's a problem there. That's too little in stocks. And I would agree. As a matter of fact, there was another article totally unrelated, and it was Dalbar had done some research. Standard asset allocation models are wrong, according to Dalbar. That was, Think Advisor, they had done this article. And so here's the problem, is that if you look at market downturns, having that much in fixed income is way too much inflation risk. Now, that's the short version of the article, but that's the issue. When I have fixed income investments and you have inflation, you're losing money. It's not acceptable to have 50 or 70% of your money losing money after inflation. It just doesn't make a lot of sense. For most investors, I guess I'll say there may be some exceptions, but I can't think of any at the top of my head. Yeah, it's great that 70% of my money is losing money after inflation. But anyway, so it says, in fact, however, dozens of additional factors are relevant when determining whether a given glide path is optimal for a particular investor. Analyze the interactions between these factors turns to be very, very complicated, Professor Duarte says. To illustrate, say you lose a job during an economic recession and stocks plunge. Depending on how many years you have to retirement, the losses to your portfolio may be a matter of less than your loss of income. Determining proper investment allocations needs to take into account not just the stock market's historical return profile, but also your age and vulnerability of your job to the business cycle. That's difficult enough with just a few variables, but becomes almost impossibly complex when incorporating many additional factors. So in essence, what this is something I've talked about before is, your asset mix, how much I have in stocks and bonds can be driven by a lot of factors. How many years before I'm going to retire? How solid, how stable is your job? If you're in kind of a risky job, you might not want to have all your eggs in the stock market basket because the stock market can move with the economic cycles. And just when you're more likely to end up losing your job or getting laid off or something bad's going to happen at your company, all of a sudden, now your stock portfolio is down and you're laid off and you need money and you have no money in fixed income investments because you didn't have a big enough emergency fund or whatever. And that can play into it too. How big is your emergency fund? So that's another issue that you think about. Now, another thing is you might have a job that is very, very much in economic cycles are actually part of your work. And the reality of it is you may end up having to retire sooner than you thought you were going to have to retire. And you don't want to have your job and your stock market portfolio all together. Now, a perfect example with that would be, let's say, a financial advisor. A financial advisor who is paid based on, the assets being managed, or a mutual fund manager who is being paid based on the assets they manage. All of a sudden, their portfolios go down that they manage just because markets fluctuate and their income goes down, and they have no fixed income to actually pad themselves. So that would be one very obvious example of that. So looking at how you allocate, that could be a factor in that as well. Is, how much at risk are you in your work? How much risk of what if you can't work and what if you do need some of this money a little bit sooner? As Professor Parker, and there's this another area goes this to overcome this complexity, researchers turn to a type of artificial intelligence known as deep learning. As Professor Parker describes it, they used historical data to set up a model of the game of life, and in other words, a risky economic environment to which people earn, save, and invest over their lives. They're basically kind of running this program as things that might happen. Now, we've used probability analysis for years in the financial planning process, and that's just going and taking and randomizing different things that might happen. And this is something that we're seeing more in financial planning programs. What if they change the tax laws? What if in 2025 they go back to the old tax laws? What if taxes increase in the future? What if you end up going into a nursing home at a certain point in time? And it is very much like this. So this is kind of the direction that the industry is going, and it's going to get really interesting. But it says that at each successive round, it learned what might be different variables, which were better or worse ways to invest a retirement portfolio. Computer eventually gained insights that were beyond our reach before that, they said. No other modeling equity allocation up to this point has taken into account as many different variables. And that's the beauty of computers. I mean, when it comes to, like, for example, Social Security, and we think about that and modeling that. And what if this person dies at this age? What if this person lives to this age? What's the life expectancy, joint life expectancy? What are the tax changes that could actually affect Social Security taxation when you're drawing money from a portfolio? I mean, there are a lot of different things. So you come up with an asset allocation based on a lot of this stuff, and this is really where the industry has been going. Now, it says that a typical glide path, the problem that they had with it, used by target date funds, was way too conservative, starting at the age of 50. You're literally looking at what mix of stocks to bonds, and it's just wrong. It just doesn't work very well. And it didn't work in their game of life. Well, that is the problem that I've had for a long, long time. And if you look at fund companies, they all do it. And you go, well, why do they all do it if it's not that great? Well, there's safety in numbers. If every fund company is making the same basic mistake, how do you hold any of them accountable? You don't. That's the answer. Now, this is wealth. An investor with a great net worth is able to take more equity risk. There's another variable right there. If you've got a lot of money, you got a lot of wealth, you got a lot of assets, just naturally you can take more risk with your stock portfolio. Well, target date funds don't take that into account. This reminds me of, I had done this thing a while back where I actually had these two lines. It was in a really interesting course that I had taken, and it had one line that started up high and it went down. It went down, 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 and down. And then the other line started way down and it went up. And what it was looking at is the need for diversification. The bottom line was, the horizontal line, the x-axis, was your age. And what the second line, the one that started low and then went up high, was showing was the importance of diversification. And it was basically saying, when you're young, diversification really isn't that important, typically. Simply because of the fact that you got so much time before you're actually going to be living off of your money. Now, the other line, the one that started high and then went down, 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 and then dropped off, it was basically saying diversify like crazy when you're young. Because when you're young, you need to have lots of skills, lots of knowledge. You have to have educational diversification. You have to have diversification in terms of how you earn an income. So diversification is really, really important there. But as you get older, it's not that important because your number of years before you're going to retire is going to be shorter. And that would be something you would play into and how to mix a portfolio. And, your level of diversification might make it so that you might be that person that, hey, you know what? If I feel like working another 5 years when I retire, I'll work another 5 years when I retire. No big deal. Now, a couple of things they had in here I wasn't so crazy about, and it was funny because they talked out of both sides of their mouth on these, but it was state of the business cycle and market valuation. There's where you run into the problem where they're talking about, these target date funds. Well, they're mainly investing in big growth companies, and historically, right now, the prices on those companies is pretty doggone high compared to historic norms. So, of course, since most target date funds do that, they, of course, would have to address that in this article. I would say the better way to address that is make sure you're holding value stocks, make sure you're holding international, better allocations to that, better allocations to small companies, because small companies, right now, the prices are not high at all compared to earnings or book values. And value companies, much, much lower. But yeah, I could see where that would definitely be the case. But then, to their credit, they basically took that back and they said, researchers acknowledge the dividend price ratio, which is how they measured market pricing, isn't a dividend to price ratio. So what are the dividends being paid out compared to the price of the stock? If they have really high dividends compared, to the price, that is a more value orientation is what they're saying right there. They've got a lot of profits for what somebody's paying, low price, the denominator. If you have a really, really low dividend paying out compared to price, in other words, you get further to fall, is what they're saying right there. But, it's turned out to be far too pessimistic picture for equities in recent years. In other words, what they just said with that line is, it doesn't work. Maybe we thought it did, but it doesn't. So maybe you can ignore that. But I think the general gist of this that I want you to get is target date funds, one size fits all, tends to fit nobody. And that's the problem that you run into with these programs, is they just don't fit people's real situations for all of the reasons that I gave. And you might want to just, when you're going through your 401k, choose your own investment, or better yet, have somebody that knows what they're doing choose the asset mix based on your particular circumstances. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., PWI, an investment advisor registered in the state of Tennessee. PWI does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation. This information is provided for informational purposes only and should not be construed to be a solicitation for the purchase or sale of any securities.